Hey everyone, welcome back to the channel. If you're new here, make sure to hit that subscribe button so you never miss any tips on how to improve your financial situation. In today's video, we're going to talk about something really important: investment instruments. Whether you're new to investing or have been at it for a while, understanding the different types of investments is crucial to building your wealth. We're going to compare some of the most common investment tools like stocks, bonds, mutual funds, and ETFs. You might be wondering, how do they all work? Which one is right for me? Well, by the end of this video, you'll have a clear understanding of each, how they work, and when they might be a good option for your investment strategy. So let's dive into it. First off, what exactly are investment instruments? Simply put, they are products that you can invest your money in with the goal of earning a return. These can range from things like stocks, which give you a share in a company's ownership, to bonds where you're lending money to a government or corporation in exchange for interest. There are also mutual funds and ETFs which pool your money with other investors to create a diversified portfolio of assets. The goal with all of these is to grow your money over time. The right investment instrument depends on your financial goals, risk tolerance, and how long you're willing to let your money sit before you need it. Some investments offer the potential for high returns, but also come with high risks. Others are lower risk, but offer more stability and smaller returns. Let's go over each of the main types of investment instruments to see how they stack up. Let's start with stocks, which are probably the most well-known investment type. When you buy stocks, you're essentially buying a small piece of a company. This makes you a part owner of that company. If the company does well, your stock's value will likely increase, and if the company does poorly, the stock's value could decrease. Stocks are typically seen as high-risk, high-reward investments. They tend to offer the potential for higher returns than other investment options, but that comes with the possibility of losing money, especially in the short term. On the upside, stocks have the potential to deliver high returns, particularly over a long time horizon. For example, if you're investing in growth stocks, you might see your investments soar as the company expands. Some stocks also pay dividends, which are a portion of the company's profits paid out to shareholders. Dividends can provide regular income, which is one of the appealing aspects of owning stocks. However, the downside is that stock prices can be volatile, meaning they can go up and down unpredictably, often influenced by factors like the company's earnings, the overall market, or even things happening in the global economy. This can make stocks a bit risky, especially if you're trying to make a quick return. But if you're investing for the long term and can ride out the ups and downs, stocks can be a great option to build wealth. Next up are bonds. A bond is essentially a loan that you give to a company or government in exchange for regular interest payments. When you buy a bond, you're not buying ownership in a company like you are with stocks. Instead, you're lending your money with the agreement that the issuer will pay you back after a certain period, usually with interest. Bonds are generally seen as safer investments compared to stocks, as they provide regular income through interest payments. They also offer more stability, making them a good option for people who are risk-averse or looking for steady returns. The downside is that bonds usually provide lower returns than stocks. They can still offer a decent return, especially if you're buying government or high-quality corporate bonds, but they don't typically have the same high growth potential. Another potential downside of bonds is that they are subject to interest rate risk. If interest rates rise, the value of existing bonds may fall because newer bonds will offer higher interest rates. But overall, bonds are a safer investment and can help balance out a portfolio that's heavy on riskier assets like stocks. Now let's talk about mutual funds. A mutual fund is a pool of money from multiple investors managed by a professional fund manager. Instead of buying individual stocks or bonds, when you invest in a mutual fund, you're essentially buying a piece of a portfolio that consists of many different types of assets, like stocks, bonds, or other securities. Mutual funds are often more diversified than individual stocks or bonds, and they provide a way to invest in a variety of assets without needing to pick and choose them yourself. The benefit of mutual funds is that they provide diversification, which means that your risk is spread out across multiple assets. This helps reduce the risk of your investment, since one poorly performing stock won't tank your whole portfolio. Mutual funds are managed by professionals, so they're a good option if you don't want to worry about selecting investments yourself. However, mutual funds do come with some drawbacks. For one, they charge management fees, and these fees can eat into your returns over time. Also, because they're managed by professionals, you're paying for their expertise, but you don't have direct control over the specific stocks or bonds in the fund. Additionally, mutual funds only trade once per day, which means you can't buy or sell them throughout the day like you can with stocks or ETFs, which brings us to exchange-traded funds. ETFs are very similar to mutual funds in that they also pool investors' money and invest in a diversified portfolio of assets. The key difference is that ETFs trade on the stock market, which means you can buy and sell them throughout the day, just like stocks. ETFs offer many of the same benefits as mutual funds, such as diversification and professional management, but they come with a few advantages. For one, ETFs generally have lower fees compared to mutual funds. This makes them a more cost-effective way to diversify your investments. They also offer the flexibility of trading throughout the day, which gives you more control over when you buy and sell. Plus, because ETFs track specific indexes like the S&P 500, you can invest in a broad swath of stocks or bonds with just one purchase. That being said, ETFs can still be risky depending on the assets they hold. For example, an ETF that tracks a volatile sector like technology or energy could be subject to big price swings. ETFs are a great option for people who want the diversification of mutual funds, but with more control over their trades and lower fees. Finally, let's touch on a few alternative investments that you might come across: real estate, commodities, and cryptocurrencies. These are generally considered riskier investments, but they also offer the potential for higher returns. Real estate can provide consistent income through rent and offer the potential for appreciation if property values increase. It's a popular choice for long-term investors, though it requires significant upfront capital and may be harder to manage than stocks or bonds. Commodities like gold or oil are another investment option that can hedge against inflation or economic uncertainty. However, commodities can be volatile and often depend on global supply and demand factors, which can be unpredictable. Finally, cryptocurrencies are a newer and much riskier investment. While some investors have made massive profits, others have seen significant losses. Cryptos like Bitcoin and Ethereum can offer high returns, but they come with a lot of volatility and risk. If you're thinking about diving into the crypto market, make sure you understand the risks and only invest what you can afford to lose. Conclusion. So, there you have it. A breakdown of some of the most common investment instruments, including stocks, bonds, mutual funds, ETFs, and alternative investments like real estate and cryptocurrencies. Each of these investment options has its own set of advantages and disadvantages, so the best choice depends on your personal financial goals, risk tolerance, and how long you're willing to let your money sit. The key takeaway here is that diversification is essential. It's not about choosing one investment over another, but rather about finding a mix that works for your financial situation. Whether you're looking for steady income, high growth, or something in between, there's an investment instrument that can help you get there. I hope this video gave you a better understanding of the different types of investment options out there. If you found this helpful, make sure to like, share, and subscribe for more financial tips and investment strategies. Leave any questions or thoughts in the comments below. I'd love to hear what types of investments you're thinking about. Thanks for watching, and I'll see you in the next video.